What I'm thinking is we'll have a really bad September and October because that's when it always seems to hit the fan. And then we'll have a build up to that. I think that the bear market rally that we had ended, and we're now in another downturn. We could have another rally after that, but some point, September, October, it's things will really have deteriorated. And like you said, you start to see big job numbers, 600, 700,000 layoffs and those kind of things. You could start to see that. But this also could extend even into 2024, potentially. It's so big, the excesses that have to be corrected. And it's hard to know for sure, but I'm fairly certain that 2023 is going to be a bad year.
Welcome to Wealthion. I'm Wealthion founder Adam Taggart. Well, it feels a lot like 2008. When the world was glued to the newsfeed, waiting to hear which entity was the next casualty of the unfolding financial crisis, as well as what new extreme measure world governments would announce in response. In times of heightened anxiety and uncertainty like this, it's wise to tap the perspective of seasoned analysts who have studied and experienced decades of market action. There are patterns to history that, when understood, give us an advantage in assessing the probabilities of what's likely to happen next. Which is why we're fortunate today to speak with Fred Hickey, editor of the highly respected newsletter, The High Tech Strategist, which Fred has been publishing since 1987. Fred, thanks so much for joining us today.
My pleasure.
Well, Fred, look, I've been looking forward to having you in this program for a long time. We scheduled this discussion, I want to say almost months ago. Who knew it was going to be so crazy when you finally came on here? I appreciate you taking the time during what must be a very busy time for you in covering all this action to come on and talk with us.
Certainly not easy to keep up with everything these days.
Yeah, right. Well, gosh, if you're saying that, the rest of us don't have any chance. Well, look, lots of questions for you, but if you don't mind, let me start with my customary one. I like to ask everybody at the beginning of these interviews. What's your current assessment of the global economy and financial markets?
Well, I think that as far as the economy goes, we're heading towards recession. When you have central banks around the world that had lowered rates as far as they had to 0% in the US and negative in Europe and Japan, and then you had a great spike in a very short period of time, one of the fastest rises ever, not since the 1980s or 70s, I would think. When you go from 0 to 5% and you've built up all the debt that we have, you're going to have a problem. And it's going to lead to a recession. I can't believe people were calling for a soft landing or no landing. And of course, that went by the boards very quickly with the latest banking crisis that we're experiencing currently. So we've been in this process anyways. In the stock market, we sold off last year hard. It was one of the worst declines that we've had in some time, obviously. And then in the bond market, it was the worst market decline ever in history. So the combination was pretty terrible. And but then we had a rally. It bottomed. The S&P bottomed at 27% down in October. And then we had a big rally. And that rally took us through January, and we had the best January in 22 years. That's not unusual. Back in 2000 timeframe, we had 8 instances where the market went up 15% or more. And what those do is those trap bulls, they get people all excited. They start thinking there's going to be no landing. The bear market's over. We heard a lot of that from a number of sources. Very recently, even they still believe that there would be the bear market was over and we're in a new bull market, and that we wouldn't have a recession, we wouldn't have a hard landing. So I think we're heading towards a hard landing. Obviously, the banking crisis has changed the thought process now. Now they're worried about not interest rates rising. They're thinking the Fed will have to cut rates going forward, and that's the result of the downturn that's in process. When you have a banking crisis like this, you always have tightening of money, and that will also make it harder for for earnings to hold up, and they're not going to hold up. They were in decline already, and they'll continue to do so. I think that in the stock market, we were in. I agree with what Jeremy Grantham, GMO, founder of GMO and the great historian, called the super bubble. And he said that there were 4 great super bubbles in the last 100 years. One of them was 1929. One of them was in Japan, 1989. And then we had our great 2000 bubble that I was deeply involved with because it was tech driven. And now this one. And if you look at the valuations, this one relative to the other US bubbles was the greatest ever. So, and valuations, even though we had that sell-off last year, they've only come down to levels that are now at the peak levels in 2000. So price to sales ratio of 2.2 times is exactly the peak level in 2000. Market cap to GDP, 150% today. It was 200%, but 150% today. Well, the peak in 2000 was 140%. In 2007-8, and that market top, you were 105%. So you can see how high we got. It was insane. It was a super bubble. And when super bubbles pop, they don't just go down a little bit. We're down on the S&P, and it's up here today. We're down on the S&P only in the teens right now. And that's not exactly bear market action. Super bubbles dropped 50% or more. So in 1929, the Dow went now 90%. In 1989, Japan, that dropped 80%. The NASDAQ in the tech bubble in 2000 dropped 84%. We're nowhere near that. In January, usually there's a change of leadership. We didn't see a change of leadership in January. That rebound that we had, a bear market rally, brought us back to buying meme stocks and Party City and Bed Bath & Beyond, and back to buying Tesla again, and back to buying Kathy Ox ETF, and options, 1 day to expiration options. This is not in any kind of indication that you hit capitulation. In bear markets, the last third of all bear markets are the worst, and that's when there is capitulation. We haven't seen any of that yet. That's ahead of us, and these rallies that we've had here throughout this bear market are normal, and they catch people. They destroy the maximum amount of money because they suck people in, and that's what this latest rally did. And so now we're heading down again, I think. In fits and starts. And then, these bear markets usually go in at least 2 years at a time. It takes time for that to suck in the money and make people capitulate. So I don't know how long it'll go and before we get to capitulation. And the only thing that can stop it is if the Fed comes in and once again intervenes massively, as they've done with at other periods where we've been in trouble and they've come in with money printing.
Okay, that was a wonderful answer. I took great notes, and we'll get to the possibility of central bankers trying to intervene here to maybe stop this carnage that you say history says should happen. But let's take our time to get to that, because I have a few other questions first. Just one question for you from how you sort of described all this is, you sort of started your answer grounded in central bank policy. We had been at ZIRP, had a lot of intervention, pretty much from 2009 on, until we turned everything off right at the end of 2021. And from what you're saying, it sort of sounds akin to getting the market accustomed to driving, at 100 miles an hour, and then all of a sudden the Fed suddenly slammed on the brakes. And when you say we're heading to recession, it's kind of like, because the whole system, which was accustomed to all that stimulus and cheap money, it's now like hitting the windshield, right? Is that a decent analogy?
Absolutely. But it's been going on before 2009. They came in and lowered rates in 2000 to 1%. Absolutely. Was a historic low. And then that caused a housing bubble and a global financial crisis. So it's been going on even in the late 1990s when they were intervening to stop long-term capital problem, to even the Mexican crisis that we had. They've been intervening, and never letting the markets correct. And then finally, when they got high levels of inflation, they had no choice, slammed on the brakes, and then we've seen the market decline. But every time they tried to back away, they've had a market issue. So it's not just this time. Back in 2009, Bernanke testified in front of Congress in April, I think it was, and he said, "Oh, this will only be a year or so; it's temporary." Well, his balance sheet, his QE balance sheet, has gone up by 10 times since then, and it doesn't seem to be any end to it. It just popped up 300 billion this past week on some of the intervention work they did to some of the advances they made. Now they claim it's going to be temporary; they're only 1 year, but nothing ever seems to be temporary.
Nothing's as permanent as a temporary government solution. I'll turn 52 this summer, and I've basically been alive. I mean, I think I was born like 2 or 3 weeks before Nixon temporarily took the dollar off the gold standard, right? That's been a pretty long temporary. All right, so what you're sort of talking about there is really the Fed put that Greenspan initiated there in the late 90s, and they just keep doubling down on it, right? And I want to talk about the Fed in a moment, because I want to first update everybody on what's going on in the banking system to see if you have any additional insights to add to that. But a big question out there that I'm just preparing you, I'm going to ask you is, do you think that Powell, there are folks out there that think that Powell is trying to kill the Fed put this time around, and I'd be curious to see if you think that that's his true intent here, and then if you do, if you think it's possible he could succeed on that, or is the system just so addicted to it now you just can't kill it without sending the system into cardiac arrest?
I think Powell has good intentions. He was, and if you go back to 2012 in the Fed minutes, he was the one Fed member, one of the only Fed members that was arguing against QE and talking about the dangers of QE and moral hazards and all of the arguments that I could make today. He was making them then, but he continued to vote for the QEs. When he became chairman, he tried to pull back, and then we had a bit of a crisis again. Rates spiked up, and immediately we were printing again. So there was a quick pivot, and that's what they're always looking for now, are pivots. The difference this time is that we've seen real, not just asset inflation. We saw very highest inflation in 40 years, 4 decades, and that forced him to move again. His track record isn't good when it comes to holding firm when there are difficulties, and we've seen this. We've seen there's always another bailout, always more money printing. I believe he's the one guy that would try, but I don't think, given the system where we are and the amount of debt that we have, and when you raise rates like this, what it does it blows things up, it breaks things, and I don't think that the politicians, our government, most of the Fed members can deal with any kind of pain. We've been putting off that. We haven't allowed the markets to correct, no cleansing of excesses. And so I think they hoped, at least, I know Powell hoped he might be able to get away with this, just as he did earlier. I don't hold much hope.
Okay. So you're sort of in the camp of the folks that say the Fed's going to hike until it breaks something, and we're probably seeing the first of things breaking down.
We're seeing that, right?
Yeah. And that breaking is going to get so bad, it's going to force him at some point to pivot to rescue the system.
Yes. Now, he'd be slower than anyone else because his intention is to try to break the put if he could. He knows that he should. The others don't even know that. He knows. He has an understanding of the problems, the long-term problems that the Fed has created and will continue to create. So I wouldn't count on it happening right away. That's the one thing. He'll probably drag his feet until he has no choice. Okay.
So again, sort of putting words in your mouth here. He warned us about pain. Hey, there's going to be pain coming. I think he hoped, hey, we'll get through the pain and then there'll be better days tomorrow. It sounds like you're saying he's going to withstand a fair amount of pain, but at some point it's going to get so great that he's just going to have to capitulate.
And we'll be heading into an election year too. That will make things harder.
There'll just be massive political pressure on him.
Mm-hmm.
Okay. Well, real quick, let's just update folks on the banking system situation here, which is totally fluid and may be out of date by the time this interview launches tomorrow. But the latest developments over the weekend were that Credit Suisse, which was basically one of the world's biggest zombie banks out there, it's been on life support for a long time, finally keeled over more or less as a part of the ripple effects of what's been going on in the banking system. And the Swiss government and Swiss National Bank engineered basically a bailout, a forced shotgun marriage between Credit Suisse and UBS, right? And that was done, I think, to show people, hey, we're not going to have a Lehman moment. We're not going to let this bank fail and have all that contagion ripple across the global banking system. What was, I say TBD, we're going to find out if they did a good job on that or not. But one interesting element about that is, let's see. So the terms were UBS got to acquire Credit Suisse for a little over $3 billion. Interestingly, the bank was, valued at about 7 or 8 billion, on Friday.
Right.
The Swiss government is guaranteeing UBS $10 billion worth on Credit Suisse's assets. So if those assets start going back, the government will backstop UBS. Totally understand why UBS would ask for that in a deal like this. The Swiss National Bank is giving UBS a 100 billion, probably even greater than 100 billion liquidity assistance, just to kind of keep things, working smoothly. But the interesting thing was that they decided to stiff some of their bondholders. And you would expect, bondholders to take a hit in a deal like this, but they wiped out a sleeve called the AT1 sleeve, which were the contingent convertible bondholders. And what's notable about this is not that they had to take losses; it's that they actually help. They let the equity holders retain a fair amount of value. I mean, not a ton, but about a little less than 50% of their equity, and that's really breaking the agreement generally with creditors. They're pretty much always senior to equity holders here. So there's a little bit of a scandal going on right here, and maybe this is just what they needed to do to get the deal done. I'm just curious if you have any thoughts on the whole UBS Credit Suisse solution here.
Well, as you said, it's so I've never heard of that happening. Yeah, equity, but those were the terms that there were. Those bonds were going to get wiped out first. That they should have known that if they read the details, they were going to get wiped out. The fact that the equity holders are still got something, I think that's just the way they cut the deal at the end of the day because they had no other choice. I don't know. I know that what I do know is that there's a lot of we don't know where all the bodies are buried yet. They're starting to float to the top. This wasn't the first bank to go. We've had 3 others. We had the Silicon Valley Bank, which had its own problems. They had lent a lot of money to a lot of bad loans and got hit with deposit runs.
Terrible
lost
risk
a lot of money
management
on treasury bonds. What's that?
They had terrible risk management on top of it all.
Absolutely terrible risk management. They had, but we had. This goes into my tech area here. It was when you printed that kind of money that you did, $5 trillion during the COVID crisis. It created insane malinvestment.
Yep.
We have all kinds of flying car companies and human space travel companies. And one company was going to bring back the woolly mammoth. And it was out of control, like I thought I'd never see again when I saw it in 2000, only this was worse. So, we had gone to records of venture capital money that had been infused into the system, and then they doubled it in 2021. Same thing with IPOs. It was out of control. 22,000 cryptos. So Silicon Valley Bank was involved in a lot of that stuff, and there are big losses there. But they're not alone. I mean, there are losses out there because everything was so crazy. We had what some people call an everything bubble. So we had these huge bond valuations with rates at, never seen before levels. And so we don't know what the size of losses are on pension funds, insurance companies that had trouble in 2008. We know commercial real estate is a big problem right now. What floats to the top next? I don't know, but I know it's there. When you have the losses that were taken last year, and in many cases they were just not recognized. They don't have to mark their portfolios,
right?
And that's the case with private equity, and they haven't. We just saw one fund cut their venture estimates. Had lost 60% of their money on the stock side of it, and then it cut it by like 33% this week or so. But it wasn't anywhere near what they needed to cut, what they really need to recognize. So all these losses that are still out there that can create problems. I don't think the big banks. I think Credit Suisse was special because I don't think Europe had made the corrections that we did in 2008, 2009. I don't think our biggest banks, our JP Morgans and those kinds of companies are in trouble at all. But all over the place, obviously the regional banks, Federal or Republic there is still losing and is still dropping. Last I saw it was down 20% more today. And there's a lot of others that are there. So it's hard to know. No one could have predicted. No one did. That Silicon Valley Bank was going to go, and then that Credit Suisse was going to go. I just know that the losses are out there.
Got it. So listening to you, Fred, is it sort of fair to say that after, a prolonged period of having interest rates at the lowest, as some people have said, like in recorded history,
5,000 years,
right? That went, and of course that cheap money, and cheap credit, basically flooded liquidity in the world, encouraged rampant speculation, led to all this malinvestment you talked about, therefore creating what you said many people call the everything bubble. Is it just sort of stand to reason then once that era has ended and rates start rising, especially as quickly as they have so far, you just mathematically should expect the everything bust?
And that's what I think is the super bubble bust, right? It's this is special and it's big. I knew it was coming. It's hard to predict the timing of such things, but there wasn't any doubt in my mind. Just as there wasn't any doubt that I knew there was a housing bubble. I knew that. I knew the banks were in trouble in 2008. I was short those. I knew that. I knew the tech bubble was a disaster in 2000. I was short, some puts that. So this isn't anything different. It was all, you can see it if your eyes are open. You can see it if you understand the markets. Difficulty is timing it always.
Yeah. Although, is it fair to say that you don't know when it's going to happen, but is it fair to say that the opening kickoff is now behind us? The game is in play.
No question. I mean, we had huge losses last year. Like I said, it was the worst bond market decline in history last year, and then stock market was hit pretty hard too, just not as hard as it will be by the time the bear market ends. But that all peaked, in some of the mean stuff. Kathy Wood's ARC that peaked in 2021 in February. Some of the craziest stuff then, and then the market, as often happens, the market itself didn't really start down until the end of 2021 into 2022. Mm-hmm. So this has been going on for a while now, and it's continuing. And these things take time.
Well, and to use my game analogy here, and I know I'm asking you to speculate here a bit, but like, have we passed halftime yet? Or do you think we're still in the first half?
Well, it's hard to say. I do know that, as I said, the biggest declines come at the end when there's capitulation. Right. I know that. We're nowhere near that. Usually you get change of leadership. We've not seen that. You haven't seen the big declines yet. Valuations aren't anywhere near where they should be. I'd say we're probably halftime, maybe, with a lot of pain to come.
Okay. But sort of the worst of the, trying to think of the analogy here, the opposing team is going to score more points in the second half against us.
Yes, it's going to get rough.
Yeah. All right. Well, look, let's use this as a transition to just sort of your general macro outlook here. So you started saying you see us heading towards recession, right? So as you look out, across the rest of this year, maybe heading into 2024, we had some debate last year as to whether we were in a recession or not, and what the technical definition of recession was. And if you look at the GDP numbers for Q3 and Q4, they were pretty good. I haven't looked at it today, but the last time I looked at the Fed's GDP now for Q1, I think it was still above 2%. You have data, and we can argue that it's lagging and maybe even monkeyed a bit. But if you look at, jobs data, people will say, hey, the economy still looks pretty robust, right? If you look at retail sales, if you squint and don't dig too much, they looked okay in the last report. When do you think we're going to not be debating it anymore? When we're just going to be like, okay, we're clearly in recession now. Is that happening this year, or is that a 2024 type of thing, given your forecast?
Well, we've seen all the early signs. Real estate usually blows first. It did. And housing market, I should say. Housing market has rolled over badly. Unaffordability is very high, and rates jumped up, and prices are too high. So everything's kind of killing over there. You had a badly inverted yield curve. That usually happens. Now you have tightening of money. But you're right. Well, the other thing too is employment lags. It always does. You'll see that at the end. When things get, that's when all the layoffs occur. People, especially now with the shortage of workers that we've had, people are holding on to workers longer. So that's difficult to see. Retail sales were poor at Christmas time. They bounced in January, probably because of the weather. And then, warmest January in I don't know how many years. And then February numbers were not good again. So retail sales have been generally weak. Best Buy reported, they're, again, from my technology angle, Best Buy reported a couple of weeks ago, and they can forecast continued problems into the consumer, U.S. consumer. And so did Walmart and most of the major
Home Depot,
retailers.
and yeah, exactly.
Yeah, they're all warning. One of what we hadn't seen is so much is enterprise spending dropping. And again, we had a major earnings report 2 weeks ago from Dell Computer. People don't spend a lot of time with Dell. It's not as flashy, as exciting as the FANG stocks, not one of the FANG stocks, but it's a huge company. It's $100 billion in revenues. It's twice the size of IBM. It's twice the size of, it's 40% bigger than IBM. It's twice the size of Cisco. There just isn't anybody comparable out there in terms of computer hardware. And their focus is not consumer PCs. It's corporate. It's a business enterprise. So they're number one in computer servers. They're number one in storage. All these areas, they're number one. And they gain market share, and they continue to gain market share. Well, what did they say? They said that they saw that the customers were scrutinizing every dollar, every budget dollar. They saw elevated inventories. They forecast continual declines in the infrastructure area. Storage, which had been strong, weakened in the fourth quarter. Now, the fourth quarter, the quarter that they just reported was the January quarter. So it's the latest data that we're getting. There'll be companies that will report first quarter numbers, and it'll include January in here. Across the board, broad caution in the IT spending environment. The only areas they had seen that were still holding up were financial services, construction, and real estate. Now, those aren't going to hold up either. We know what's going on. Remember, this is all before the banking crisis occurred. This happened just prior to, their report was just prior to the Silicon Valley and Silvergate problems, and now Credit Suisse and others. So now we're starting to see it. The industrial production numbers were weak. A lot of the capacity utilization was slipping. So it's starting to get into the broader economy. Some of the semiconductor companies I monitor seeing weakness in industrial as well. So it's happening. It's happening. It doesn't happen overnight. Again, it takes time. But those Dell numbers are really important. And they're forecasting much worse numbers than the quarter they just reported going forward. So they've seen big declines in PCs, but now they're seeing it in the infrastructure. They were talking about being infrastructure business being down 15% year over year. Pretty bad. And that's, like I said, huge company, nobody bigger in the tech world.
Wow,
In the hardware area.
That is great intelligence. And let me just bring it up to a higher level of tech, because you publish the High Tech Strategist newsletter. Technology is a sector that you've been an expert in for a very, very long time. You mentioned that Dell is not one of the FANG stocks, but those big tech stocks have largely been the ballast keeping the indices from rolling over. And last year, it took a while for the indices to move down, and we got briefly to bear market territory in them. But if you looked at the Nasdaq, and you looked at how far the Nasdaq was down, and then you looked at how far down the average stock in the Nasdaq was, massive difference. And it's because these really big tech companies that are a huge part of the S&P as well, they're such big behemoths, and they weren't suffering as much as the rest of the guys. So they made the index look better than the average stock, and it was performing. What is your general outlook for tech here? Will we see a rotation at some point out of tech into sort of safer plays as what you expect to see happen progresses? Or are they so big and well positioned that they're going to be the leaders going forward no matter what happens?
Right. So the Nasdaq fell 33% last year, but then it bounced 15% here or so this year in that bear market rally. And because it was a bear market rally, the old leaders continued to be the leaders again. They went right back to their favorite stocks. And the valuations are extreme. Apple's $2.5 trillion market cap, 26 PE at this point. If you go back in after the 2009 timeframe, that bear market, Apple's PE ratio ranged from 10 to 14 for several years, and didn't get above 20 until 2017. There's just no precedence for Apple to be selling at 26 times no growth earnings. Earnings are expected to be down 6% in Q1 and also down for the year. And they're in their third year of their upgrade cycle, which is not a good time for them to be in. It's not a high growth time frame. So you can't justify that. You can't justify Microsoft's 30 PE. That's another one. If you go back into that 2010 time frame, took several years for it to ever get back to a 20 PE. I also want to go back to 2000. People thought that those major stocks were invincible then too. And I've seen it every time. You go back to 1990, which is Compaq, Oracle, Microsoft, those companies were the leaders then. And they held up too until the last 3 months of 1990. And then they fell 40 to 60%. That's the capitulation phase. They were the favorites then as well. We saw the same thing in 2000. They held up, but then collapsed. And I look back in those top 10 stocks: Microsoft, Cisco, Intel, Nokia, Nortel, IBM, EMC, Sun Microsystems. The best one fell 60%, and that was Microsoft. It took Microsoft's the only one of those names that ever got back its valuation level. The only one. Sun Microsystems and AMC dropped 96%. They're part of other companies now. Cisco's down today 65%. That was the dominant company. They thought that was your Apple, that was your Microsoft of the day. Had second highest market cap. Stepped 65% down. Intel down 75%. It was the dominant semiconductor company at the time. There was nobody close to them. Nokia down 92%. That's what happens in super bubbles. Okay, we're not there yet. We're talking valuations that are extreme for these companies. Amazon's still 70 times estimated earnings. NVIDIA is 110 times. It's 22 times sales. These things you don't even see at most bubbles. And yet that's where we are right now. but the earnings are falling. NVIDIA's earnings were down 33% non-GAAP, down 50% GAAP. Now they have a lot of AI hype here, but their main business is not, the main businesses aren't doing so well. And with a recession ahead here, things are going to be bad. As I mentioned, Dell said that things are turning down. Well, it's going to turn down for Microsoft. If you're not selling computer servers, you're not going to be selling computer software. They go hand in hand. So the other part is that some of these companies, the cloud companies, the storage companies, like Amazon and Microsoft, well, they're dependent upon the crypto companies and all the flying car companies and all that other stuff. And as with lending tightening and the economy going into recession, those businesses will go away in many cases, and others will have to cut back, as we're seeing them do it. So we're in a downturn, yet the valuations don't show it, but that happens every single time. Throughout all of the tech cycles that I've had, that I've ever been through, 2008, same thing. Amazon was a favorite at that time. It fell 60% in the last 4 months. Finally, that was 2008, almost the end of the bear market. So they hold on to these things, their favorites, the ones they love the most, until they capitulate and then panic. And you get these great declines. And I expect you'll see that again unless the Fed steps in again with massive money printing.
Okay. All right. So you answered my follow-up question, which is, so do you expect the cycle to continue from here? And it basically said yes, unless there's something unnatural that the central bank step in to do. All right. Let's see here. So many questions for you. I'm just trying to pack into the remaining time we have. So on the inflation side of things, right? I mean, that's what's different this time around for the central banks, right? Is they're much more limited in what they can do because their primary goal right now is to get inflation under control, and it's proving stubborn, right? 6% last official CPI. Do you expect that to be brought under control? Because everything you're talking about here is contractionary from an economic standpoint. So do you sort of expect inflation to kind of resolve itself as we go through this process into recession and then a big capitulation? Or do you have a different outlook?
Well, inflation is starting to come down, and that would be expected. Part of its base effect. Part of it was energy prices coming down a lot. Other copper, those kinds of things, you don't need as much. Housing is lumber prices. So we've seen a lot of the commodities decline in price. All that's to be expected. But you have other issues that are pushing up inflation. You have a wage price thing going on here where we don't have enough workers. The JOLTS report still shows 10.5 million job openings, and we have 1.9 more job openings than we have workers, available workers, unemployed. We have wage pressure. I don't know if you saw, but Delta had a wage contract negotiation, 34% increase. And Americans said they'd match it. And then American pilots still going on strike, supposedly, because that's not enough. You had increases. Labor had been left behind for a long time, but now they're more in the driver's seat. And with the shortages of people, we have shortages of accountants, we have shortages of healthcare people. In New Hampshire, the hospitals all got together and said, Warren, we don't have enough people at all levels. And so expect long waits now to get healthcare. Retail, you go on and on and on. Labor has an advantage right now, and we're seeing it in higher wages. So, and that leads, when you have higher wages, corporations have to increase their prices, and some of them weren't able to get all the price increases they needed last year, so they're still raising prices. So you've unleashed that, and that's kind of structural. We've lost a lot of workers, retirees, baby boomers like myself have retired. You've lost them to, well, some cases that there's disincentives for some people to work. The COVID was a problem. Daycare is a problem. For all these reasons, we don't have workers, and then we're also globalization reversing. We had all the positive effects from globalization, which reduced prices, and now we're going to try to reshore. And when you do that, it's higher costs. So the positive things that have kept inflation in check for all those decades, really, a lot of those key drivers are now reversing. So I think you'll see a decline in inflation. And what you might see is what we saw in the 1970s, which was up and down, and then always a little bit higher. if the Fed doesn't, if Powell doesn't pivot, and
if he does, I
that's
assume
my
you say that
expectation.
we'll see substantially higher inflation result from
We
that?
could. I think we could see substantially higher inflation because of the way we've, we created incredible amounts of money supply growth during the COVID period. 40% growth in 2 years. Some of that money still floating around. If we put more in, if we continue to do that, then I think we will, because we don't have the benefit of globalization keeping prices down. We don't have the amount of labor that we once had. So these pressures are going to be, it's sort of like 70s stuff. And then I also think energy prices are going to reverse and rally again. I was in energy stocks I reduced them this year or last year. I reduced them. It was a good move. But I had a substantial energy position for a couple of years because I know ultimately we're going to have shortages again. ConocoPhillips CEO said we're going back to the 1970s and 80s. Pioneer Natural said that we'll never see the production levels that we've reached before, which is like 13 million barrels a day. And that's because of ESG, because of the Biden administration's disdain for the group. The Permian wells are seeing great production declines right now. Mm-hmm. We brought down the strategic petroleum reserve from 650 million barrels to 370 million barrels, and that helped take the price down, but that was a one-time shot. And, we've seen demand destruction, and that's also helped, and the weather helped, especially in Europe. But longer term, these energy prices, I think, are going to go higher again, and that will reverse the benefits that we've seen to inflation here recently.
Got it. Fred, I'm making a note here. I've got to have you back on again to dive more deeply into energy stocks or just the energy situation. I agree with everything you're saying. We've had experts on this channel as recently as just this past weekend with our conference talking about exactly the issues you just mentioned, but also the fact that we've been underinvesting in capital investment in energy for a good long time prior to the current administration and whatnot. So yes, there are some decisions we're making in the near term here that are disincenting the industry to invest going forward, but we've done stuff 5, 10, 15 years ago that we're going to be paying for going forward as well. And you're nodding as I'm saying all this. So I think it's a really interesting story to tell there. We don't have time to do it justice here, so move on, but I do want to flag it.
It's just that you mentioned inflation. It's an important part of it.
Yeah, no, that's great. Okay, so you sort of see this path of I'm going to call sort of secularly stubborn inflation upward pressures that we haven't had before. Where the CPI bottoms out at, who knows? But let me make this statement. You can correct it. We're probably not going back to a multi-decade average ahead of us that's 2% or less, like we've enjoyed.
That's right. I wouldn't expect that. I wouldn't expect that to happen. No.
Okay.
We'll have declines related to this recession that are causing demand destruction. But it won't go. I don't think it'll go below 2% because of all the other pressures that are out there.
Okay. There are two questions that I wanted to dig into with you. In the interest of time and getting to another rich vein, I'll just say, look, if there's anything that you want to say about either the scope of layoff risks, the risk of layoffs in this coming recession that you see ahead of us, and also thoughts on the housing market. And mostly I ask those, lumping those two together, because I'm really more interested in your sense of what the living experience is going to be for the folks watching this video going into this recession that you see ahead. Is it going to be it's not so bad, we'll just kind of muddle through it? Is it going to be it's a quick recession that we almost didn't even realize happened, like we saw in 2020? Or is this going to be more like a grinding deep, hey, people around you may be losing their jobs, your house might get cut in value by 30%, and it's going to be a long, hard slog? Where do you sort of see that?
Again, it's going to depend upon what the Fed does. But if they are slow to move, it's going to be rough because we have built up all these excesses over all these years. You need to have cleansing of the system, of the malinvestments that occurred, and we haven't done it. So you kind of build up all this inflammatory stuff that just going to blow up. And so we've seen a lot of layoffs in tech so far, but not in the major part of the economy. And I think they'll come. The only thing that does help is the shortage of workers, so that that will keep companies from laying off as many people as they would, but they'll have to. And we're already seeing that. I mean, Dell's laying off people as well as a result going forward in the last conference call here, and a lot of others will. So it'll be assuming there isn't any great tick save that jump starts everything again. It's going, and if that happens, we're just putting it off for a little bit longer anyway. So it'll be another worse decline down the road. But yeah, no, it's going to be a very difficult period. I don't think it's going to be a Great Depression. We had 25% of the population kind of thing, but double-digit kind of, you can see double-digit jobless unemployment rate potentially. Take a long time to get there because we're only at 3.6% right now.
Right.
But yeah, you could see that.
Okay, and that is sobering. I mean, double-digit unemployment is something we haven't had to deal with. I mean, we had a brief, massive loss of jobs in the pandemic, but it got addressed immediately. And
but notice it got addressed immediately, and that was the thing that turned it around. Otherwise,
right. Otherwise, it would have
COVID
been awful,
obviously
right? I mean,
COVID obviously resolved itself, but each time, in 2008, same thing.
Yeah.
The banks would have gone under.
Yeah. And I mean, one of the reasons why I mentioned this is having lived through 2008, it was just like month after month after month of hundreds of thousands of jobs being lost every single month. Yeah. And I'm just not sure with what everyone's reading with, oh, don't worry, jobs are fine. They're just not ready for that type of potentiality.
No, I'm sure not when they're talking about no landing and a week ago, no landing
right.
and soft landings. No.
All right. So I'm getting to a very particular question right before I get there. So intuiting from everything you've said so far, Fred, I get the impression that you think that we could easily have back-to-back disappointing years in the markets, right? A lot of people like to point to, oh, well, when a market's down by 20% one year, history says that the likelihood of us having a positive year the next year is X% or whatever.
Right. Sure.
But I think you're skeptical of that, saying, given the realities on the ground, there's not a great argument to get real, long the market here.
No. As I said, the valuations are terrible, and we're heading toward a recession. And as you pointed out, we're not quite there yet. There are a lot of mixed signals, but things are turning down. And I've never all the bear markets I've seen, they all, on average, they take a couple of years anyways. And so that argument, you don't have 2 years in a row. That's craziness. Especially with the valuations that you have here, they're just not going to be sustained. I expect, what I'm thinking is we'll have a really bad September and October, because that's when it always seems to hit the fan. And then we'll have a build up to that. I think that the bear market rally that we had ended, and we're now in another downturn. We could have another rally after that, but some point, September, October, it's things will really have deteriorated. And like you said, you start to see big job numbers, 600, 700,000 layoffs and those kind of things. You could start to see that, but this also could extend even into 2024 potentially. It's so big, the excesses that have to be corrected, and it's hard to know for sure. But I'm pretty certain that 2023 is going to be a bad year.
Okay. All right. Well, look, so of course, the whole purpose of this channel is to help the regular investor look through the eyes of seasoned experts such as yourself, become better informed, and then hopefully use that information to take more prudent and more informed action to protect, preserve, and hopefully at some point grow their wealth. I want to read a comment that you made on Twitter the other day and then give you a chance to elaborate on it. The Fed's in quite a pickle. More tightening to fight inflation ensures more credit events. Stop and inflation could surge even further. Meanwhile, there's still that bloated 8.3 trillion balance sheet. One day they may learn not to mess with free market forces. Got gold?
Yeah.
So it seems from a lot of your writings, and even though you're the high tech guy, you decidedly, oftentimes it seems, come back to a decidedly non-tech asset as a good thing to be holding given this current macro environment. So can you explain, your recommendations for gold in this macro environment?
Gold does poorly in times of joy. So when you're having big bull markets like the 1980s, 2000, that double time, gold was in a bear market. Prior to that, 1970s, you had a great gold bull market. And that was a terrible, terrible period for the economy and also the stock markets with major declines there. Stocks didn't go anywhere but lost money in real terms. In 2000, we had the bubble break, and I knew tech was done, that when you have a big bubble like that, you're going into a secular decline. And that's when I started getting interested in gold. Then I assumed that the central banks would kind of do what they were doing, which was always bailing things out. And I never imagined we'd get to this level. But that was a good choice to make my really first purchases in mining stocks in 2002, because they went on a terrific run. They went up 1,600%, 17 times in the 2000 to 2011 timeframe. And gold went up every year during that time for a decade because things were bad and people wanted store of values and safety. And then with all the money printing that happened, the stock markets went up, NASDAQ went up every year from 2009 on, and gold went into a correction, a major correction period. And here we are again now. We bottomed, I think, in 2000, at the end of 2015 with gold at 1050. And we seem to be going to ever higher lows with each downturn that we have. And that's because there's been enormous amounts of buying overseas from the East. The central banks bought a record amount of tonnage last year, 1,136 tons. A lot of that has to do with governments wanting to get away from the US dollar. The Chinese have reduced their treasuries from 1.3 trillion to 800 and something, it's the lowest since 2010. The weaponization of the dollar has caused a lot of countries now to be buying gold. Mm-hmm. China itself imported 1,343 tons last year, up 64%. India, Egypt, Bank of Singapore bought 45 tons in January. There's this huge buying that's going on. So China imported all that gold last year, but that was during an economic downturn when they were closed, and now they're open. And we're seeing, in February, their imports, through the Shanghai Gold Exchange, 169 tons in 1 month. It's up 84% from where they were in 2022 in that month in 2021. So there's enormous demand that's coming in from overseas for gold because they see the situation. We may see us, we're not going to have a hard landing. We're not going to have, it'll be a soft landing. Everything's fine. Stock market won't go down 2 years in a row. All that stuff, that's not how they see it. They see big troubles here in the West. Massive deficits, $31.5 trillion, and not a lot of fiscal responsibility shown. And so they're preparing and they're buying gold. And the Western investors have not. So they say the East, the Asians will set the floors for gold, and we've seen that floor rise. So it was 1050. Then it went up to 1180 in 2018. Then it jumped up to 1610 last year. That was the bottom. This year, it looks like the bottom was $200 higher, 1810. Last night, we went to $2,000. Yet we went to $2,000, but the Western investors don't have any positions right now. So they've taken their positions down to points where you usually get big rallies. Silver went negative in the COT report for managed money, the speculators, hedge funds, and CTAs, and gold was down to 14,000 net long contracts. These are bottom levels, open interest. for the futures traders was only 423,000 at the beginning of this, end of February. These are all signs that you're going to have another rally from the low, the bottom, the floor that was set by the agents and others that have been buying. And so it's kind of a perfect scenario where you have inflation, you have loss of confidence around the world, the central banks are buying, overseas buyers are buying, the Western institutions don't have any positions. They took their ETF, the GLD is the largest ETF, and they took their positions down by 200 tons in this latest downturn, and they only added 20 back in this latest rally. And they're going to have to increase positions. They used to have larger positions. Maybe up to 5% of their portfolios were in gold, and now it's a fraction of 1%. You raise that to 1 or 2, 3% and see what happens to gold when there doesn't seem to be a lot of gold around, or even silver. Technically, gold tremendously oversold in this latest downturn that seems to have ended for sure. Longer term, there's this giant cup and handle for over a decade that the gold people talk about. That is like a perfect indicator for a blast off of the price of gold. We're also heading into the 8-year cycle, the better part of the 8-year cycle for gold. People like my friend Felix Zuloff and many others look at that very closely, and there is that pattern. So next year and maybe even early this year, we're heading into the best 3 to 4 years for gold. So everything seems to be coming together. Even last year, when rates were up and the dollar was soaring, gold held its own. It didn't go down, and that was a major accomplishment for gold, given the lack of interest in the U.S. But it was because of all those Asian buyers and others that have been buying gold. So in an inflationary environment with all these debts, with a recession, the gold does well during recessions. These are perfect times for a big rally in gold that might be at the level that we saw in the 1970s, where it went up from 100 to 850, or in the 2000 timeframe when it went from 250 to 1900. So it could be many multiples of where we were from the bottom.
Okay, that's what I was going to ask. So what would the modern equivalent of that be? Would that be sort of at the 5,000-ish level? Higher?
Higher, maybe 8. Yeah, given all the money that's been printed, yes.
Wow.
Could be. And some people have a lot higher numbers. I don't like to throw those big numbers out. I'm just telling you, it's a perfect setup right now.
Okay. And if we were sort of talking about the 5,000 to 8,000 range here, what's not saying you're calling exactly for this, but what's a credible time frame you think that could be reached over? I'm just trying to get a sense. Is it like in the next year, or is that sort of like a 4-year type of journey?
Yeah, it's probably 3 years, maybe. That's when we talk about that 8-year cycle. The big years are the 3 years, the first 3 years of the 8-year gold cycle. So I would say 3 years would be, and then what you end up with that is a bubble at the end of it, which
right. You got to sell,
typically have, and that a lot of it comes at the end, and then the last of it, just like you get capitulations at the end, you get spikes at the end of big bull markets as well. So yeah, that's what I would think. But boy, we're in a really good position right now with everything that's going on in the world.
Okay, so you had another comment you put out on Twitter, where basically you just said, "Welcome to day one of the gold and silver mining rally." You give your reasons for why you think that should happen. They're largely commensurate with what you've already said here. But you said a big part of this is just going to be, continued heavy buying from overseas as they continue to understand what a financial mess the West is in. So in terms of the miners, which are obviously the leveraged way to play the prices of the metals, you talked about the metals potentially going up several multiples in a relatively short period of time. I'm intuiting that you think that the miners could then have a massive run, like you've said they've had earlier before when you first started getting into them at the beginning of the millennium. You're nodding as I'm saying this. So I guess one of the questions I want to ask you is this the back up the truck moment for the miners? Or is this more sort of a, begin to dip your toe in if you're not one yet, but it's not the time to go hog wild just yet?
I think it's the back your truck up time, and here's why. So the miners have been depressed, oversold. They're not purchased by overseas investors. Overseas investors in China and India and Turkey and all those places buy gold. They don't buy Barrick gold. They don't buy Newmont. That's the purview of U.S. investors and Canadian investors. They're the ones that are primarily buyers of those. So while we had this big move up in gold from the 1610 level, now the 1810 level, all the way out, miners haven't really performed. And one of the reasons is last quarter, if you look at the numbers from last quarter, the average realized gold price was $1,730 for the gold miners. The all-in sustaining cost, that includes almost all the costs, including the cost to reverse depletion, to refill reserves. The all-in sustaining costs had gone up with inflation because energy costs were up and costs for grinding materials and cyanide and all these different things. Costs are up 14%, and the average all-in sustaining cost in the fourth quarter was $1,231. Well, $1,231 and $1,731, that gets you $500 margins, right? Right now, we're at $1,980 to $90. Now, $1,980 to $90 minus the $1,230 is $750. So what you've just seen in a matter of weeks, 2 weeks here, is a 50% increase in margins. Okay, they've gone from $500 margins to $750 margins. Now, we didn't even see $750 margins on average in that 2000 timeframe when these miners had gone crazy. So this is going to be one of the highest. So their numbers don't reflect this yet. They're going to blow away earnings numbers while the rest of the economy is doing very poorly and people are cutting estimates and the tech company earnings continue to fall. The gold mine stocks earnings are going to go up. And that's why you typically see a 3-to-1 leverage, gold stocks to the gold price. And you look at what they call the Huey to gold ratio, which is the gold stocks. Huey is an index of gold stocks to gold. It's currently at 0.122. In the 2000 timeframe, when during the best of the years in there, that was 0.46 at average, 0.46, or almost 4 times the level it is today. It went to 0.6 something, right? Five times. So you can see how depressed they are relative to the price of gold. But there was a reason for that, because their margins were falling and people didn't like it when their earnings are falling. Some of the companies like Newmont and Barrick were cutting dividends. Well, guess what? Cash flows are going to go up too. And the dividends are going to start rising again as well. So we're right here. It just happened. And the miners are barely up this year. I think the juniors are only up 3%, and the GDX major miners are only up 6 or 7% or something like that, and it all had occurred last week because they were down in the year. So we are on day one here almost. We're week one. We're 1 week into this, and so far the prices are only going higher right now. As I said, we hit 2,000 tonight. We're backing up just a little bit right today, which was to be expected. But the technicians are talking about breakouts and all of that kind of thing. Think about what the margins would be and what the cash flows will be and the dividends will be if you're talking about much higher gold prices, as I just talked about. It's just enormous. And that's why you get, in the 1970s, the small miners went up 30 times, some of them. The big ones went up 10. In the 2000 timeframe, like I said, it was a 17x increase, because the leverage on the bottom lines and on the cash flows and everything else is just fantastic. So if you believe that this is the perfect scenario, and which I do, and we're on the cusp of something really big right here, then the miners are going to be a great play.
All right. Well, that is fantastic. I'm excited to hear that. But on this program, Fred, it really is all about helping people build wealth, right? And to build wealth, first, you got to protect it, and then you have to grow it. And for so much of the past year plus on this channel, we've been talking about all the reasons to be defensive and concerned and whatnot, which still exist in spades. But where we can identify potential opportunities of undervaluation in the market where something's going to get repriced to the upside, it's great to be able to highlight those opportunities. So thank you for doing this for our viewers. I want to just note to folks here that we just had the Wealthion spring conference this past weekend, and Rick Rule, famous natural resources investor, dialed through a number of his stock recommendations in the precious metal space, as well as in several other sectors for natural resource investing. So if you're looking to get some specific stocks to go investigate, if you haven't, if you didn't attend the conference, it's not too late. You can buy the replay videos for that over at wealthion.com/conference. Fred, in your newsletter, do you give recommendations as well for particular mining stocks, or do you tend to trade in the major ETFs for the sector?
No, I don't deal with ETFs. Because I've been involved with the group now for over 2 decades. I do know something about them, I think, and I can do a little bit better than the ETFs themselves. So, and I have. It's been I've done okay. Happy with them. So yeah, what I tell people is what I own. So I don't recommend any recommendations or suggestions to people in terms of percentages or anything like that. This is what I own in my circumstance, and these are ideas for you if you're interested. And so yeah, I do. I can name them. I could give you, if you wanted, I could give you my favorite major miner, my favorite intermediate miner, and my favorite junior miner, if you want. I don't.
People would shoot me if I said no. So yes, please.
Okay, so my favorite, there's big 3 miners, and one of them is Newmont, one of them is Barrick, and one of them is Agnico Eagle. And Newmont and Barrick haven't been able to grow. The industry isn't really growing very much. Barrick's numbers last quarter were at a 22-year low for production, or last year. And Newmont's been stuck at 6 million ounces a year. Agnico is a grower, and they have very good growth prospects. So as a result of that, you get a higher multiple. They also are thought to have the best management team, and their mines are located in the best jurisdictions in the world. They purposely stay out of difficult areas, so you won't find them involved in Russia or South Africa or Venezuela or any places like that. Most of their mines are in Canada. They have a mine in Australia. They have a mine in Finland. But these are all very highly rated jurisdictions. So from a security standpoint, being able to sleep at night, they're very good. Pays a dividend, has for 30 plus years. It's pretty good dividend, 3.3%. Stock is down because the miners were depressed here recently. Their costs are going to go down in 2024 and 2025. So and that's because they have higher grade mines coming on. So not only you get the benefit of the higher gold price, but you also have lower costs expected. That's their forecast. So that's my favorite, and it's always good to be buying when the CEO is buying as well. And he bought at the end, just a couple of weeks ago, he bought $400,000 worth of his own stock in the open market. So that's also a very good thing. So that's my favorite major. My favorite intermediate is Alamos Gold, AGI, and again, the best locations and all of their production is North America. Most of it's from Canada. Their costs are declining even more so. And this is very rare to have costs declining in this industry. Their costs are declining. Their all-in sustaining costs were a little over $1,200 last year. Last quarter, it was less. It was in the $1,130 range. They're forecasting $1,000 by 2025 because of these very high grade. They have an expansion in Canada at Island Gold. It's going to double production at these huge grades and low costs. They also have a lower cost production coming from a mine in Mexico. So the valuation is they buy back shares. They don't have any debt at all. As I said, the best locations, and they're only a little bit above their net asset value right now.
Wow.
Very, very cheap, even though it did well last year, but it did well because things were going well for them last year too, in that downturn for many of them, with higher costs for most companies. And then the final one would be a junior, and I don't think it has any peer among juniors, and that's Osisko Mining, and that's that would be OSK on the Toronto Exchange and OBSK NNF on the New York, where you trade at New York. It's has a mine called Windfall that is thought to be one of the most significant discoveries in the last 100 years, one of the top ones. We haven't had many, and this is one of them. This is a 10 million, likely 10 million ounce mine. All-in sustaining cost estimated at $758 because the grades are so high on this thing. They're going to be double-digit, 10% plus grades. I think they've had some samples that have come out a lot higher than what their feasibility studies have been. Again, it's in Canada, so it's a great location. It's cheap. One of the reasons why it's down recently, it fell, was because they had a bought deal offering that put pressure on the stocks. That gives you an opportunity to buy some also. But now they don't need money from an equity offering for a year and a half. There'll be some kind of a deal because they're beginning to bring this together, and they should be producing gold by 2025. So juniors don't produce, but this is one that will be in the near term, a relative near term. So it's there's a lot of these juniors that go up a lot because they're really cheap. I mean, I'll give you an example of one. I won't mention the name, but it's all-in sustaining costs are almost equal to that 1,730 average realized price. So they're getting no margin, but at $2,000 and 19, now they have $200, and they had nothing before. So you can see the leverage on that one. But these are all I think the highest quality names, really good. I don't go out with the ones that where there's a liar standing next to a hole, and you can get your big bang from those. Penny stocks, there's a million of them. I only stick to the highest quality ones where they've identified a lot of gold, a lot of reserves, and they're solid management. The other thing about Osisko Mining is that management team also has already built the Canadian Malartic mine, which is one of the most successful mines in Canada. And then they sold it, and they are doing, I think, the same thing. I don't know if they'll sell it or not. They don't want to sell it cheap. They've had interest, and they've because of what they have in hand. They think they kind of made a mistake when it was sold. It's now owned by Agnico Eagle. Fantastic mine, and they built that themselves. And the same group is building this one as well.
Wow. Well, Fred, thank you. That was just pure gold. Sorry, pardon the pun. But that really was exactly the kind of, insider insight in terms of, identifying the wheat from the chaff that folks love to see on this channel. So thank you so much for doing that. It's interesting. Wealthion's actually been in touch with the management team at Osisko to see if we can get the CEO to come on this channel and actually tell their story. So it's great that you actually picked them out there. All right, look, well, Fred, this has been wonderful. You've been extremely generous in your time. We've gone way over the allotted time I said we'd have for this interview. So thank you for sticking with us here. I'm going to wrap it up here. I know I'm going to disappoint a lot of people who would love for us to keep going, but hopefully, Fred, we can have you come back on the channel at some point in time and give us an update on your outlook as we're further into the year. Very importantly, though, for folks that have really enjoyed this discussion, maybe the first time they're actually getting to see you speak, where can they go to learn more about you and your work?
We don't do any advertising, never have. Thankfully, we never had to in the 36 years we've been doing this, never had to advertise. I am on Twitter, so you can kind of read some of the tweets there. And that's at HTSF Hickey, I think. I believe it is that. And then also, if anybody has any interest, we can send you all the details about the newsletter. If you send us an email to the High Tech Strategist at yahoo.com. That's THEHIGH, strategist as it's spelled, at yahoo.com. You send that to us, we'll send you the details if you're interested.
Great, Fred. And when we edit this video, we will put the URLs up, both to your email address and your Twitter account, so people know exactly where to go. This has been great, folks. As you, I'm sure, can gather at this point in time, the High Tech Strategist is one of the most respected financial newsletters out there. You now totally understand why, having listened to Fred talk here for the past hour plus. Highly recommend, if you're interested in more of what Fred has to say, that you take advantage of him by emailing him and signing up for that newsletter if you can. All right, real quick, as we just wrap up here, a couple quick resources for folks. Just want to remind folks that if you didn't watch our conference from this past weekend, which was amazing, you can still get access to the replay videos. You can go purchase them over at that wealthion.com/conference URL I mentioned earlier. Also, Fred painted his outlook for the rest of this year. I think to say that it's going to be challenging is probably quite an understatement. And this is why we recommend so many people subscribe to expert newsletters like Fred's, but also, if you have a real life and you don't have the time to watch the markets the way that an expert like Fred does and react to the shifting landscape here, that's why we highly recommend most people work with a professional financial advisor who understands the issues that Fred talked about here and takes those into account when helping devise a portfolio strategy for you. Beyond just developing a plan, you want somebody who can be your partner and actually, executing the strategy, especially as it has to react to changing developments on the ground. A lot of what Fred's outlook depends on is what the Fed does next from here. So you need to have somebody who is paying attention and making decisions based on that, not somebody who's just saying, hey, market will always take care of you in the long run, and just basically puts you 100% long and doesn't look at it again for the next couple of years. If you have a good advisor who is playing that role for you, excellent, stick with them. But if you don't, or if you'd like a second opinion from one who does, feel free to schedule a free consultation with the financial advisors that Wealthion endorses. To do that, just go to wealthion.com, fill out the short form there. Doesn't cost you anything, no commitment to work with these guys. It's just a public service that they offer. Fred, this has just been absolutely wonderful. Thank you so much. Folks, if you'd like to see Fred come back on this channel again at some point in the future, please support us by hitting the like button, then clicking on the red subscribe button below, as well as that little bell icon right next to it. Fred, I can't thank you enough for the extremely generous amount of insights you shared with us today.
It's been my pleasure.
All right, everybody else, thanks so much for watching.